Thank you all for being here. I guess we'll have more attendance as the panel proceeds. But to set the context, we have with us two experienced veterans from the private equity, and Blackstone and AION Capital, Anurag Das, who's the CEO of IARC, and Blackstone makes all of its stressed assets investments from IARC, and Kalpesh from AION Capital, Senior Managing Partner, which has a fund and ARC. And as we all know, the biggest question is why aren't PE firms doing more deals in this space when there are so many opportunities available? So to discuss that, if I can open the session with a question to you all on what your burning issues are from a fund perspective.
So firstly, let me just say as context that we think from a market environment perspective for a global investor, the kind of stuff that the government of India has done over the last couple of years is path-breaking, and we are a big fan of what's happening in the country. Now, obviously, we can do things better, so the comments that I make during the next 30 minutes should not be misconstrued to say that, everything is wrong. I think we're doing a great job as a country, and obviously we want to do better, and that's all of the comments should be taken as constructive criticism.
Absolutely.
In terms of your question,
yeah.
We think the amount of capital which has the skill and the risk appetite to bring the equity layer into India, which is what is sorely needed. As we know, Indian corporates have been built on series of leverage layers.
Right.
So you have operating company leverage, you have holding company leverage, you have holding company leverage, and so on. So true equity has been low.
Right.
And that's something that the country needs, and this is the time when we need it the most.
Right.
So opportunity to bring that kind of capital into the country and availability of that kind of capital, we think is at all-time high.
Right. Okay. Anurag, you have any thoughts on,
I think I'll preface it very similarly with the fact that I think burning issue,
yeah.
There's always a micro-level burning issue in any investment people like us look at.
Right.
But I think the big burning issues have been sorted out.
Right.
Which is, you have a new law. There used to be concerns that the courts won't be able to handle it. They're handled by new courts. There was concern there's no other infrastructure, legal or restructuring oriented. And over the last 3-4 years, you've put large, complex cases through the jurisdiction's various facets. So all those things are in place. Now, what are today's burning issues? There'll always be something. I don't think it's systemic in a manner that can be fixed without just living through it. Right? The level of expertise, perhaps across the board, whether it's from people like us who bring one level of expertise from somewhere and kind of bring it in, there's pieces that are missing. So is the information great? No.
Right.
Is there something you can do by snapping your fingers to fix it? Not really. Is the mechanism and mode by which we acquire assets and feel comfortable with taking measured risk relative to the outcomes perfect? No, it's a work in process. But, I think there's been remarkable progress on pretty much everything that's mattered, either a little bit early or a little bit late, but I'd say pretty much on a timely basis.
Right.
With the most recent amendment, all that's in place. So I think as a jurisdiction, the question is really how do we solve for these couple of things that lie behind bringing capital, a good chunk of which is really equity capital. So I think differently than multi-layered levered structures, when you look at a distressed situation, the reality is you buy distressed debt at some price, and if you buy all the distressed debt, now that has the entire cap structure captured in it.
Right.
And so it needs a large equity layer coming out of it.
Right.
And the appetite for putting in capital based on the legal kind of construct around it is the burning issue that people like us have to help solve. The system's done what it can.
Right. No, I actually want to start with the legal uncertainty bit, with the recent Moore's judgment and the government's reaction to it. One feedback from the earlier panel was that the deal flow has actually reduced because of the SR judgment into the IBC. Is that something that you saw from a fund perspective?
So obviously the previous panels, and I see Shardul here, have commented on, so people more qualified than me have commented on that judgment. What I would like to take away from that incident, however, is the speed of response of the executive arm of Government of India. I think that was phenomenal.
Right.
And that, as an investor, as a global investor, I take it as a big positive.
Right.
There will be judgments which will be idiosyncratic, which may not fall within our understanding of what is the right way forward. You cannot solve for that. That is the human element of the process. But the question is the Government of India fully behind making IBC the primary and the sole way of resolution?
Right.
This action clearly shows that. So in a perverse way, I'm happy
Right.
what happened did happen,
Right.
because it did demonstrate the willingness, and for people in the room who've heard Nirmala Sitharaman speak about the amendment when she brought it into Parliament, I think that was fabulous as a global investor.
Anurag, do you have any thoughts on the amendments?
I think they were necessary. I think the fact is we miss the big picture sometimes, but in reality, what sits at the heart of IBC matters every day, every time any person puts one single rupee of debt into anything. Right? It simply doesn't matter as long as it's not an individual, because we're not dealing with personal bankruptcy law. But if you lend to an entity covered under the statute, every single day you do that, how and where the waterfall comes in matters every single time, right? What happens at the end is fairly defined. And if you make that ill-defined in a manner that runs contrary to the logic of solving for how you put in that capital, you have a problem.
Right.
So here, if you start to say, oh, we'll see what the waterfall looks like, you have a problem. In fact, I think we've come a long way with this step, but we've got one more step to go, which is the way creative energies and innovation come into insolvency and problem solving in insolvency when companies run aground is by conceiving of outcomes, trying to say, okay, in liquidation, this is worth 100.
Right.
And party A and party B get 50 each. In resolution, it's worth 200. The waterfall mechanism and the liquidation backstop, right? Avoiding liquidation requires establishing in law and in a resolution that both parties will get at least that 50. Where you need creditors kind of arguing with each other, negotiating with each other through a market mechanism and process, in trying to get the resolution value to go up, be that 200 or 300, and bet on it with capital, is how you divide that surplus. So imagine that you think it's 200, liquidation value is 100. In insolvency, under the Insolvency Code, you could get 50 and I could still get 150 and be okay, or vice versa. It's about deciding how you split that 100. So I think one very important piece here is done, dusted, and fine, which is you can't contravene the waterfall in its substance and over-reward parties that should not be rewarded according to the waterfall just because it's a resolution plan. So you can't run the alternative aground. The next step someday will be, once the system gets oiled up, as to how you divide the surplus. That will require creditor clauses and require people with differing interests negotiating to share that surplus. So I think we're 80% of the way there, and we'll all solve, I think, over the next few years for the next 20.
Just to add to what Anurag was saying, I was hoping we would have been 100% of the way today, with the Supreme Court having met yesterday. Unfortunately, we don't have a judgment, but it should happen in the next week or 10 days or something like that. So the waterfall and the priority of the contract of a senior secured lender versus a second lien lender versus an unsecured lender is the basis of credit world over, right?
Correct.
I don't think as a country we are going to redefine that, and I hope we're not. And the highest court in this country is seized of the matter. We should hear the response in short order.
Right. Yeah, I think that's fairly established now. I want to actually have your thoughts on two other aspects that came up in your introductory remarks. One was the quality of information that is available. You've done deals in this space. How do you, when there is no quality of information, how do you move forward? How do you kind of do your due diligence, and how do you make your decision?
So that is indeed both a challenge and an opportunity. We do buyouts in India, as we do world over, and we do distress buyouts in India. the difference between the quality and the quantity of information and the timeliness of the information in India is wide between these two styles of deal making. Not as much in other markets that we operate. What it means, in fact, is that the number of firms which can specialize in being able to deal with this level of information is fewer, right? So as a firm which is in this space, it gives us a bit of an advantage. How do we turn it in our favor is that we have certain sectors which we have deep expertise in. These are sectors which we own companies in globally, right? So we also have a strong relationship with the banking system over here. So we have a good view on what are the assets which are likely to get into trouble, which means you do not wait for the asset to be admitted into an NCLT before you start doing your work. Oftentimes we've done work for over a year on a particular company before it actually gets into IBC. That's what gives you an edge when it comes to other people who are just going to show up the day this company is, the resolution professional calls you up or sends you an email saying, by the way, this company is in now NCLT, would you like to bid? That's a bit too late.
Okay. You have thoughts on that from an ARC?
Yeah, I'm not going to profess to be as ambitious that it gives us an edge. But I think in a market at the stage we're at, if we can get to sort of the ability to do it, that's an edge, right? There's a plethora of opportunity because lots of problems need solving. They involve this sort of capital. And I think if I had to answer your question literally, I think we are sort of going round and round, trying to solve the quality of information problem. Sometimes it's a gentle up spiral, we kind of end up solving for it. Sometimes it's a very chaotic down spiral, and we can't do the deal. So I think there's one thing in this business that is inalienable from being successful in this business, and that is making decisions under uncertainty. I mean, this is the business of pricing certain types of corporate revival risk and recovery risk under uncertainty and being able to allocate capital. A solution to that problem has been evolved over the years in other jurisdictions. We have a somewhat specialized width and depth of both reliability of information and the quality or depth of data. So you adjust, but that adjustment's iterative. So all of us try to get started early, focus in certain areas. When these situations come up, we go either up spiraling gently, and we get some things done. On the rest, we try hard, and then we can't find an answer. So I think obviously one of the great hopes is, as that information is asked for in one situation, the ecosystem evolves, starts to learn to collate, analyze, provide that data. The second time around in something similar, the advisors, the restructuring agencies, staff at companies start to understand. So there's some adaptation from people like us who picked this up other places, and from people in our ecosystem who are starting to provide the info. And hopefully we'll solve it at some point.
When I speak with my friends at the big banks in India, and they're obvious that their always complaint is you guys bid too low, so we have a huge haircut, etc. And my advice always is that, what is the best thing you can do for yourself, right? Get 5 of us bidding for the same asset. That's your best case outcome, right? Get more competition. And the reason why many more people are not coming in is because the quality of information you're providing is poor, right? So for people in the room who are service providers, right, this is a huge opportunity. A distress buyout in India, there is paucity of good quality information. It is in the interest of this country, it's in the interest of the banks that they get as many bidders as possible. So helping these banks organize the information in a manner which can be consumed by a typical buyer, right? You need to design for a typical buyout firm. That's the ask. If you can get close to that, you're going to get 10 people competing for the same assets, and that's your way to maximize value. And like I said, it's a huge business opportunity for some people in the room.
In fact, there's some very simple ones, right? Imagine that the data, take even State Bank of India, one of the most sophisticated PSU banks, the largest bank in the country. Even in a distress situation where a handful of people are supposed to look at it and try buy it, the data can sit scattered at a branch. The expectation is we have the resource to send somebody out to the branch, not to the company, not to go look at where the operations are, not to visit competitors, not to research customers, but to go to the selling bank to inspect old files and try and get data that sits there. I mean, a simple fix is every single thing that needs to go into an ARC or a non-ARC sale that's distressed. The data should be scanned. It should be certified that everything that they have is there, and if something's missing, it's their problem. You put it online, you'll have 10 bidders, or maybe 2.
Right.
So I think there's some very simple things that can be done with respect to making the data more accessible. When I have no data, I have a very simple answer. My price is 0.
Right. That's
I
true.
have a price. I'll take no liability.
Yeah.
We'll make an honest effort to fix it. We're happy to take it at 0.
Right. Is the data better in the pre-IBC stage, or?
Absolutely. When it's pre-IBC, as a buyer of the company, it's very close to a regular investment banking run process. So you have the best-in-class investment banks running the data room.
Right.
The response time in terms of the time within which they give us the information that we need is very good. Obviously, these are companies under stress, so they're battling to survive. So this is not still buying a debt-free company. It's not exactly comparable to that, but it's pretty close.
Right.
So, and just to add to what Anurag says, for us, as buyers of the business, as owners of the equity, it obviously goes beyond just the bank loan files, right? So I'll give you an example. In an IBC company that we are currently bidders for, the resolution professional has arranged for my team to go and spend time at the plant. We obviously want to buy that particular asset. They have decided in their wisdom that we need 4 hours at the plant. 4 hours is what they think we should spend at the time at the plant. This is a plant, let's call it about $800 million. That's the enterprise value. They for some reason, think 4 hours is appropriate amount of time for us to be spending at the plant, figuring out this is the asset that I really want to buy. That just doesn't work. I don't understand what they're solving for. It's not that we are finishing every resolution in 270 days or 180 days anyway, right? If 4 hours was like a week, I don't know what would have changed in their timelines. But those are the kind of things that people need to be more thoughtful about.
Right. You have such experiences?
Absolutely. I mean, people are imagining that insolvency resolution is solving the business insolvency.
Right.
It's actually solving for the entity insolvency, right? Clearly, the 15 things that are problematic underlying company are not all going to get fixed in 6, 9 months or, 330 days, 11 months we're going to have now. But 11 months is plenty to resolve an entity's insolvency, to decide what the liabilities are, decide what the assets can be determined to be worth, and freeze that value. Someone pays it, and you know how it's going to be distributed.
Right.
So these mechanisms exist. By and by, they'll creep in, which is you say, oh, something's too uncertain, or the solution's going to take 10 years.
Right.
When you take the residential real estate insolvencies, you're not going to build 50,000 apartments on a large tract of land and kind of sell them overnight. If you're clearing 2,000 a year, Mumbai has more apartment supply than 10 years can soak based on current rates.
That's true.
So imagine that all of this was one industry. Would you solve for it overnight? No. You can't just sell them to somebody. Somebody comes in and says, here's how value will be realized. That's the asset side. Here's how that value needs to be distributed. So the distribution must be firmly frozen, cleaned out, and the assets can be partitioned. In this sort of situation, the entire asset's a future pool and how it solves. So we're not going to be able to change the underlying gestation or nature of a problem. We'll have to find solutions that kind of fit in the other side. So I think very quickly we'll start to see some interesting innovation around that. We have the luxury for now that we can just copy smart practices from other places where they've evolved.
That's true.
And now that you have this amendment in place, I think you have, out of the 10 most important things that were needed, I think 8 are in place.
Right.
Right. So
what are the other 2?
I think creditor clauses is key.
Right.
We will find sometime in the next 2, 3, 4 years, if not earlier, that we will systematically achieve poorer quality outcomes for the lack of having created the ability for people to come in. And I'll give you a simple example. Imagine 80% voting power is in the hands of one party. The other party is 20. They have the ability to be creative.
Right.
And if someone owns that piece, they can come in. That creditor clause, if it was separate, would try and be creative and create extra value. But the 80% guy decides where the value goes if the plan is to be approved. So you have every possibility that the 20% voting power party is going to have to remain satisfied with liquidation value and a little bit more.
Correct. Yeah.
So the surplus is misshared.
Right.
That leads to, it's like not having a patent law.
Right.
If you can't claim reasonably for the effort invested, You won't come up with those solutions. So that's part one. Part two is some very other simple things that have been solved elsewhere. So there are things called convenience claims, administrative claims, things you give a priority. We have CIRP cost. There are bits and pieces there, but you have things like electricity costs.
Correct.
As long as they're sort of corporate office costs, not manufacturing costs, or vice versa, belong on either side of the administrative priority or not. So I think administrative claims, convenience claims, both the termination and determination of claims, termination of contract, and what arises from it. Leases. Can you terminate a lease? How do you tabulate what that liability is? Does it get capped? Where does it get admitted? These sorts of things. I think cleaning up the liability side firmly and putting in provisions so some of these very simple things start to happen quickly and won't take time. To his point, I don't want to go look at the bank's files.
Right.
There should be a very simple process by which people who specialize in that can look at it, and we should be able to focus on solving the problems we specialize in, which in most other contexts is not understanding the Punjabi title. Right? I'm not going to learn Punjabi to understand a Punjabi title, and I'm going to trust a translation.
Right.
So we're stuck with someone looking at it, and we waste time in that. That should be zero allocation of time in our business. Yeah.
These were the post-acquisition concerns that you had, after an asset is acquired, whether all liabilities are taken care of automatically or does the buyer get stuck with them. This is something the amendment also solves for, actually, the recent amendment.
Can I jump in for a second? Actually, not at all.
Okay.
So, the point is not that if we're in, it matters.
Right.
Anyone investing capital is trying to peer through the process to the end and evaluate what it means.
Right.
So the point I was trying to make was, every time somebody is lending 100 rupees to a cycle repair shop, if it's the right kind of legal entity, somewhere in the backdrop, they're internalizing what happens if this goes wrong. Every single piece of credit in a system that prices credit properly incorporates a notion of what happens when they're not paid.
Right.
So in reality, we're not waiting for everything to solve. Every piece of debt I look at, every element of the legal uncertainty is something we're pricing for in some way.
Right.
So I completely agree. And again, we've lived through acquisition after IBC, and our learnings are, again, the intent seems to be, again, if I hear what the FM said in the case of the last amendment, was to say all arms of Government of India will honor whatever has been finally approved under the NCLT, by the NCLT under IBC. That is factually not happening.
Right.
You do have arms of the government, be it the tax guys, be it industrial development authorities, be it electricity boards, who do not seem to get the message. Now, there are other arms of the government which have worked overtime, and I must acknowledge here, their efforts. So we've dealt with the Reserve Bank of India, with SEBI, as and when the IBC has evolved. These agencies have kept pace on the regulatory intent of what government is trying to achieve. So it's not that everybody, all arms of Government of India are sleeping. There are arms which are working overtime to actually stay in lockstep, right? To make indeed the intent into reality. But is it universal? No, it's not working. All arms still need to get with the program. Because if finally a buyer buys a company with X liabilities, and if new liabilities from Government of India are going to creep out of the woodwork, nobody's going to come in and buy the next company.
Right. Yeah. I want to move to the next part of our discussion, which is, I wanted to get some thoughts from you on your bidder strategies and how, when you all partner with strategic players and say other funds, what are the things that you look at, and does it seem like now as we go down the list, these kind of partnerships will reduce? That has been the general sense. So what are your thoughts there?
For us, I must say, it is not reducing. We have such partnerships in place with strategic players, both domestic as well as internationals, and those are working wonderfully well. So we are a big fan of creating these partnerships between a private equity firm and a strategic. There are obviously differences on what you're trying to achieve in the end game. Those are the challenges that you need to solve for in a good partnership. But if you can do that, we think that combination is far more powerful than a pure PE play or a pure strategic play.
Right.
Do we do pure PE plays? Yes, sure we do. There are situations where we are bidding alone because we just couldn't find the right partner for that asset. But for multiple assets, we are partnering up with strategics, and there is intent. Now, I must caveat this to say we focus on the larger end of the market where there is adequate interest both from PE firms as well as strategics, both domestic and global. As you come down that chain into more mid-market, probably it is tougher to stitch these partnerships. There isn't enough meat on the bone for both partners.
Right. Anurag, your thoughts and also the kind of strategies that you follow.
We'll try and wrap up quickly. I want to make sure we leave some time for questions if there are any.
Yes,
otherwise,
absolutely.
we can pick up again in this.
Yeah.
But very simply, two broad buckets.
Right.
In line with the theme of this particular panel, distressed private equity. You're
Correct.
trying to provide that layer of equity, comes stapled with debt in the pre-existing structure based on what we pay.
Right.
So there's that one aspect. The other aspect is a little less active. It may be a little bit more trading-oriented or less active in terms of engaging with operations, where it's a sort of distressed M&A type investment based on a premise that in insolvency someone will come bid. But in our sort of business, you want to be able to be sure that you're willing to bid at that value in reasonable situations. So on the one side, we're trying to look beyond the insolvency resolution to the business resolution and expect in partnership perhaps to have some kind of role to play. In the mid-market, to Kalpesh's point, we're really just partnering with a promoter we're happy to work with in helping restore a substantive ownership to them through a certain kind of rescue process. The other is we're seeing management teams approach us that are looking at other companies in distress, hoping to do what is traditionally a sort of management buyout of another company. And that's another sort of not quite as wide a strategic partnership, and that's starting to happen. So I think distressed private equity is seeing those couple of flavors. Rescue capital prior has a less active flavor of strategic partnership to it. And finally, there is
the management.
Just stuff where we're buying in the hope that we have a large enough position.
Correct.
And if we don't, then we made an investment, someone else acquires it. So obviously in rescue, if we're working with a promoter, I don't think it's as wide a strategic partnership. It's a rescue partnership for that period of time.
Thank you so much.